million family liquid and they want advice right now, early second quarter 2017, of some directions in the market and what their asset allocation could look like. Why don't we reposition that question, maybe only slightly? What are some things that type of family should be aware of right now and maybe should be looking, whether it's to exit, hedge, or be more aggressive?
Well, aggressive takes many different forms. And one of the best investors practicing that art today is Seth Klarman of Baupost. And Seth, he doesn't have any set asset allocation. His default state is cash. Without compelling opportunities, he is prepared to hold and has in the past held cash upwards of 50% of the assets of his fund. And I think that to me, as a simplifying approach to things, is the way to think about a portfolio. You begin with the assumption that in the absence of opportunity, you conserve cash for opportunity. And the trouble with levitating, percolating, happy, clappy markets is the thing that your teenage children likely call FOMO, the fear of missing out. And almost no one is immune from the siren song of FOMO at times like this. Your neighbor, even if your neighbor lives 500 acres away in Greenwich, Connecticut, your neighbor is getting richer than you are because you are conserving cash in the expectation of commanding bargains to come to the fore after the present cycle of overvaluation ends. That's your approach as a value investor. However, you can't help but notice that this small neighbor of yours is making money hand over fist by owning Tesla and Amazon and Facebook. It's annoying to see other people get rich. So I think that one should walk around the block and consider the opportunities that we're on offer at every single market break in our recent history, whether it go back to 1990 in real estate and junk bonds, if we go back to 1987 famously after the stock market break, and we would go forward to 2001 in technology, 2001 indeed, and 2 and 3 and 4 and 5 and 6. 2008 and 9 were great times of harvesting. There come times periodically in which things are truly commandingly cheap, and that, to me, is when great fortunes in the public securities markets are made. It's not by scaling in to rising markets and allocating assets in some formula. It is the patient waiting out of the market for that time of absolutely compelling, scary compelling bargains, because you're going to be scared like everybody else when these bargains materialize. But that's what cash is for. So you ask what to do with $1 billion, and one answer I know is to do nothing.